Headline inflation was only a tenth above expectations in January. Core was in line. But it appears that markets looked at the details and came to the realization that the Fed has been trying to hammer home for months now. Bringing inflation down to that 2% target is going to be harder and bumpier than markets expected. Here's the data. 0.5 on the headline number. We're expecting 0.4, and that's up from 0.1%. The year-over-year did tick down, but it was one of the smallest declines we've had since the summer. Core coming in line with expectations, 0.4%. Again, ticking down a tenth, but lower than the declines we've had in that year-over-year rate over the past several months. How did we get there? Energy came back again, 2%. It had been a reason why inflation was falling. Not anymore. Home ownership, owner's equivalent rent remains strong, up 0.7%. Food up 0.5% with a big jump for eggs, in fact. Used cars were down and airline fares were down, but some skepticism that those kind of declines will continue. Conrad de Quadros of Breen Capital writing, there is no slicing or dicing of the data that makes uncomfortably high inflation go away. Most importantly, Fed Chair Jay Powell's most important benchmark, he's highlighted core services, taking out housing, ticked up by a few tenths though the year-over-year did come down just a bit. We had a pretty big reaction in the bond market, pretty sharp. 2-year yields surged from 450 to around 460 in an instant and remained just a bit below their 1-year high of 467. More importantly, the Fed and the Fed funds futures market now in virtual agreement about the path of rates. Markets, in fact, a bit more hawkish near term than the Fed, seeing a peak rate of 525 in the August contract, and then a tweak down to 504 by year end, just a bit below the average for Fed officials. Really no difference at all. Rabila Faruqi of High Frequency Economics writing, for Fed officials, a slow grind down in inflation only supports the higher for longer view on interest rates. Policymakers have more work to do in lowering inflation back towards target and likely will continue lifting rates. And right on cue, Richmond Fed President Thomas Barkin in just the past hour in a Bloomberg interview saying that after the number, that there's a good case for leaving rates higher for longer. Guys?
Steve, I mean, we know data is only as good as what you collect and how you analyze, aggregate, and essentially slice it. So I got two questions for you here. And the first is, Peter Boockvar this morning points out that in terms of the CPI data collection, that the BLS has changed how they calculate it and that it's using just a 1-year comparison rather than 2. I'm wondering why and what that does to this inflation reading discussion. And also, just as importantly, we're coming up on the year anniversary of Russia invading Ukraine. We know that sent inflation readings higher in the months following it. So what is that going to do as we look forward into this year to the year-over-year comparisons? Do those matter as much, or is it going to be more about month over month?
Okay, so let me take these sequentially. The BLS, for what it's worth, is trying to give a more contemporary look at the dynamics of inflation. And what they've done is they've gone to seasonal adjustments and weightings that are 1 year old rather than 2 years old. And I guess that's trying to reflect a more dynamic economy, more dynamic pricing structure. I can't argue with it either way. I think they've probably thought a lot about it and think it's a better way to build a mousetrap to capture price changes in the economy. What we do know is it did lift up inflation rates in December, so the December rates we thought were lower, minus 0.1, in fact, became positive 0.1, and they revised up October and November as well. As for the year-over-year rate, you are 100% correct. You will have a decline in the year-over-year rate because those big boosts to inflation that came after the invasion of Ukraine will drop out of the index. That's why we're looking at these 3 and 6 month buckets. And the trouble with those right now, and one of the reasons is the big disinflation dovish case, Morgan, was built on these 3-month rates. And this kind of number today, it does kind of put a wrench into that idea that the 3-month rates were moving down slowly and inexorably. Now there's a little more wobble in them.
Steve Leisman, always love that we can ask you questions like this, get as wonky as possible, and you've always got an answer in English, I might add, to counter for our viewers.
Thank you.
Thank you.